Today, we will talk about joint stock companies. A joint stock company is a business owned by its investors, with each investor owning a share of the company based on the amount that they've invested. It is a predecessor to the modern-day corporation, and other types of registered companies in the U.S. Joint stock companies were created to finance endeavors that were too expensive for an individual or even a government to fund. The owners of a joint stock company expected to share in its profits. Today, U.S. companies are not organized as joint stock companies. While one could describe a business with shareholders using the term joint stock company, there is no such registration option. Instead, businesses are organized as, for example, a corporation, a partnership, or a limited liability company. Shareholders of a joint stock company had unlimited liability for company debts. In the U.S., the legal process of registering as a corporation or limited liability company reduces liability to the face value of stock owned by the shareholder or the contribution of the LLC member. In Great Britain, the term limited has a similar meaning. The shares of a joint stock company are transferable. If the joint stock company is public, its shares are traded on registered stock exchanges. Shares of a private joint stock company are transferable between parties, but the transfer process can be limited by agreement. Historically, due to the nature of joint stock company unlimited liability, a shareholder's personal property could be seized to pay off debts in the event of a company collapse. A company registers with state and local authorities to be legally allowed to conduct business in the organizational form it selects. This is a company that is incorporated under a nation's royal charter. Chartered companies may have certain privileges that relate to conducting their business operations. A statutory company is one that is established by an act of a nation's legislature to provide public services that benefit the populace. The company's responsibilities and privileges are detailed by the act. While a joint stock company is not a specific, legal form of a business entity in the U.S., the term could be used to describe a corporation, partnership, limited liability company, or public company, in fact, any company with more than one shareholder. The joint stock company has a historical association with unlimited liability and the potential for the seizure of personal assets to satisfy outstanding debt. A modern-day public company with shareholders is still a joint stock company, but its legal status limits shareholder liability to ownership/contribution amounts. There are records of joint stock companies being formed in Europe as early as the 13th century. However, they appear to have multiplied beginning in the 16th century when adventurous investors began speculating on opportunities to be found in the New World. European exploration of the Americas was largely financed by joint stock companies. Governments were eager for new territory but were reluctant to take on the enormous costs and risks associated with these ventures. That led entrepreneurs to devise a business plan. They would sell shares in their ventures to many investors to raise money to fund voyages to the New World. The potential for resources to be exploited and trade to be developed was attractive to many investors. Others wanted to claim real estate in the New World and establish new communities that would be free of religious persecution. In American history, the Virginia Company of London is one of the earliest and most famous joint stock companies. In 1606, King James I signed a royal charter permitting the company exclusive rights to establish a colony in what is now Virginia. The Virginia Company's business plan was ambitious, ranging from exploiting the region's gold resources to finding a navigable route to China. There was none. After many hardships, the company successfully established the Jamestown colony in Virginia and began to grow and export tobacco. However, in 1624, an English court ordered the company to dissolve and convert Virginia into a royal colony. The investors in the Virginia Company never saw a profit. Joint stock companies played a major role in funding the settlement of the original colonies. These companies could raise money from many investors, without exposing any one investor to excessive risk. This allowed the companies to raise enough resources to launch successful settlements in the New World. One famous example was the Virginia Company of London, which funded the settlement at Jamestown. Yes. Today's joint stock companies in the US are called corporations, partnerships, and limited liability companies. While there is no legal business registration form labeled as joint stock company, the term can be used to describe any business entity that issues stock and has shareholders. Joint stock companies can raise a large amount of money by issuing shares to various individuals. This made them practical for U.S. colonial-era ventures that couldn't be financed by one person or entity alone. Of course, the shareholders all expected to receive a portion of any earnings, commensurate with their investments. The legal liability that shareholders must shoulder is different. In the past, any shareholder could be held totally liable for debts that a company owed and couldn't pay. Shareholders' personal property could be seized by creditors or the authorities as payment. Today, a shareholder's liability is generally limited to their investment in a company. A famous joint stock company was the English East India Company, which was formed to trade with India and Asia. Over the course of its 250-year history, the EIC effectively controlled the colonization and exploitation of India and other overseas territories. Here are 5 key takeaways. 1. Joint stock companies are the ancestors of the modern-day corporation, although there are legal differences. 2. A joint stock company is a business owned by its shareholders, who can buy and sell shares freely. 3. Historically, the shareholders of a joint stock company could bear unlimited liability for debts owed by the company. 4. In the U.S., incorporation limits shareholder liability to the face value of their shares. 5. An example of a joint stock company was the English East India Company. Hope this would help. Thanks for watching.